What is the problem with a 60/40 portfolio for retirement portfolio? Hi, my name is Gary Mashurus. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So I think, I talk to a lot of people who are either in retirement or close to retirement. And the question comes up as well, hey, what is wrong with just your typical 60/40, 60% equities, 40% fixed income kind of portfolio that most financial advisors kind of adhere to? And maybe they'll modify it a little bit, maybe they'll move around, in certain ranges, but that's more or less what it is. And within that, in the bond portion of the portfolio, they'll buy either government bonds or very high grade bonds with very low risk of default. And in the equity portfolio, they'll buy blue chips. Now, so, life is good, right? You have low risk, you have a stable portfolio, you have some income component, and there you go. You go ahead and you retire. Great. Well, I think it's highly suboptimal at the current in the current environment with the current prices, and I'm going to tell you why. So let's start with the fixed income component. So let's say you're using government bonds as a starting point. So you're lending to the U.S. government, the same government that's printing massive amounts of money, with its printing press, at a sub 1% rate. If you're buying, bonds that are, say 5, 10-year bonds. And that's less than the stated kind of target for inflation. It's not necessarily stated officially at the Fed, but it's understood that the Fed is targeting inflation in the, around 2%, maybe 1 to 2%, something like that. And that's roughly where CPI has been trending in the current period of time. So so you're basically giving 40% of your capital at negative real rates of return, meaning that the purchasing power of your money is going to shrink over time. It's not a great idea. I'm sorry, it's just not. I don't know how to break it, but that's just not what investing is. Investing is you lay money today to increase the purchasing power of your capital in the future, right? This doesn't seem to do it. Now you can say, well, what about some corporate bonds? And maybe with corporate bonds, you can get close to what inflation will be. But again, if you want to stay in the very safe category of bonds, the spreads or the difference between corporate bonds and government bonds are so small that you probably still are talking about inflation-like results at best. And now, if you want to go out riskier, well, but then that's not really safe. You can lose all your money, as a few companies found out in the last couple of weeks as they filed for bankruptcy, and as their credit holders are discovering, who thought they were well protected. Anyway, we'll see what happens. But the point is, 40% right there is allocated to stuff that's just kind of a bad investment. Like, I would love to hear the opposite point of view. Maybe I'm missing something. I'm not saying I have all the answers, but leave a comment and tell me why, if you're a long-term investor, you want to be buying bonds at the current time. No, high-grade bonds. Leave a comment below, please. Okay, so what about the stocks? Well, what kind of stocks I typically put in the 60/40 portfolio? These are these big, well-known, highly followed blue chip stocks. Why? Well, there's a couple of reasons. First of all, one reason is a business reason. The typical financial advisor, who's going to review the portfolio with the client, doesn't want to explain some small esoteric, company that they found. What if that company doesn't do well and they lose money? They don't want to, look like a fool to their client. But if they buy Amazon or Facebook or Google or whatever the popular stocks are these days, I'm not saying those are or not good investments. I'm not saying it at all, but I'm saying if they buy them, these well-known household names, and they get them wrong, they'll be in the same basket as all the other or a lot of other investors, and their clients won't blame them that much. They won't ask that many questions and so forth. Incidentally, this doesn't necessarily work out very well. Maybe 15, 20 years ago, GE was one of these no-brainer, one-decision stocks, amazing company, safe, blah, blah, blah. And just look up the stock chart of GE. So again, just because something is perceived to be as a blue chip, amazing company, doesn't mean the stock results will will be very good. So just be careful with that approach. That's number one. What's the other reason that they're doing it? Is because frankly they don't have the tools. I don't think the investment tools to go searching for some kind of undiscovered opportunities. That's not their day job. They kind of manage people's accounts. They set up their financial plans. They spend a lot of time on business development and so forth. So the 60/40 portfolio ends up with a bunch of well-known, kind of well-followed, and most of the time fairly efficiently priced large cap stocks. And the 40% is the bonds we talked about. Well, if you look at the current market prices, I would say the best case returns you can expect from a basket of large, well covered, blue chip equities are, on a 10-year basis, 20-year basis, something like that. I have no idea what's going to happen next year or next month, but on a 10, 20-year basis, I would say mid-single digits would be a very, very good outcome for many of these stocks, if history is any guide. So, so here we are. Let's say maybe inflation, is 2% over the next 20 years. I don't know what it is, but something like that. It would be not unreasonable. By the way, there is some probability of much larger inflation, but I'm not even going in that direction for the purpose of this analysis. Let's say it's a couple of percent, and maybe you get 5%, 5-6% from 60% of your portfolio, and maybe you get 1% from 40% of your portfolio. So you're essentially giving money, and that's before, by the way, that's before any fees or transaction costs, right? So you subtract 1% or so for the standard fees and frictional costs that are being charged to you by someone managing the portfolio, and man, there's not much left for you. You'll be lucky if you more or less preserve your purchasing power at the portfolio level of your assets, and especially if you're taking money out, you're setting up a portfolio that probably is going to not do as well as certain other choices. Now, each situation is different. And by the way, if just gives you the peace of mind to stay in well-known companies and government bonds, and it makes you happy and you have plenty of money and you don't care about optimizing the returns, that's fine. Because honestly, for a lot of people, if it's the kind of mental peace of mind, can be worth more than optimizing the returns. But if that means worrying about what's happening to your portfolio day in, day out, I'm just pointing out the trade-offs you're making. If you're invest in one of these 60-40 portfolios, just understand that there's a cost, and the cost right now is that you're getting fairly low expected returns from your capital. If that's okay with you, that's fine. But I think that it's just something you should know and should understand before you kind of assume that that's the best outcome there is. I hope this video has been helpful to you. If it was, please hit like and subscribe to my YouTube channel. Thank you.